You just obtained a copy of your credit report, and perhaps your credit score isn't what you were expecting. This video is going to discuss credit scores, how they're calculated, and what you can do to improve your credit score. Hi, I'm Tom Christiano of Blankingship and Christiano, and with me is Hugo Blankingship. Hugo, what are the different types of credit scoring models and how do they work?
Well, there's a number of different credit scoring models, and some banks and lenders have their own proprietary ones that they request third parties to provide them special scoring model based on their needs and wants. But they're all basically pretty similar. I mean, obviously, if you pull your credit score, you're going to see a different score for Equifax on 3 or 4 different models, but they're not going to be off by very much. They're going to be fairly close together. And you might see a difference between Equifax and TransUnion versus Experian. But again, they're all going to be pretty close. Now, the major ones are the FICO, the Beacon, and the VantageScore. Now, who's using these credit scores, Tom?
Well, typically credit scores are used by lenders in order to assess and evaluate the ability of a consumer to repay a loan based on their prior credit history. So FICO and Beacon and Vantage are all different but similar. They have different proprietary items that go into how they calculate the score, and it's not exactly known what the specific things relate to the specific scores, but we do know the categories and the percentage of activities that will affect the credit score.
Well, the actual details are proprietary, as they say. So we don't know exactly how they do it, but we've got a general idea that's pretty well established across the board. So when you apply for credit, the creditor is going to put you in a tier, and there's a number of different tiers. So the top tier is going to be the group of people with scores about 760 to the top score of 850. And then graduating down are going to be the lower tiers until you finally get down to 620 and below, which is what they call subprime. So if you're at 620 or below, you're at the bottom of the scale, and you're going to pay the most for the credit that you do. Now, Tom, how would that impact a mortgage, for example, depending upon what tier that you're in?
Well, for a mortgage specifically, the tiers are going to translate to what the interest rate you're ultimately charged on your mortgage. So some people qualify for prime rates, whatever the current prime rate is, could be as 7% if in a high interest rate environment, or lower interest rates if you have a lower or higher credit score. So we're talking about hundreds of thousands of dollars could be at stake based upon whether or not your credit score is 690, where you just barely get approved for a loan, or it may affect whether you need to put more monthly payment down, or if your score is higher and the rate's lower. The getting a loan is a analysis of many different factors: the collateral, your capacity to repay, and your credit score. So if your credit score is lower, then you may necessarily need to come with more collateral or more down payment money, or perhaps even mortgage insurance. It could be a big problem.
Well, okay, so let's talk about the breakdown and the major factors that go into these credit scoring models. So there's basically about 5 different categories that they look at. And the top category, the number 1 category, is what they call your payment history. Now, in the payment history, it's going to look at what you do for each of your trade lines, or each loan that you have outstanding. And the things that it's going to look at is 30-day lates, collections, charge-offs, paid collections, those sort of things. Now, most people don't know this, but one 30-day late, if you have a credit score in the high 800s, if you're just 30 days late on one account, it could impact your score by 70, almost 100 points negatively. So you fall really fast with one just minor issue. Now, Tom, what are the things that we see as credit reporting lawyers that are errors in the payment history?
Well, when it comes to the payment history, you need to look into exactly what were the details of the payment. How was it made? Was it made on time, or was it more than that was owed, which can affect on a mortgage scenario, whether or not the money, sometimes people try to pay more on a mortgage and then the payment isn't allocated correctly. So we've seen many different kinds of errors, and really a good practical advice that I've seen, Hugo, that I like is, and for some of these accounts, in order to avoid a 30-day late, you could automate payments. But we've also seen errors with automated payments where the automated payment will not be taken, or they stop the automated payments. So you really have to be mindful of everything when you're talking about credit scores and trying to avoid that 30-day late payment that you spoke about earlier.
Yeah, and sometimes we see charge-offs that are inaccurate or done way prematurely, particularly by utility companies like Verizon. You might go from being current on your account or not even reporting on your account to immediately to charge-off. So those are big problems. So ultimately, we do have clients that come in and say, look, I made this payment on time, showing me as a 30-day late. Can you help me fix it? Another issue that is important in this category is less than full balance due. Now some people who have gotten really far behind and they're in collections, and they might have a collection agent call them up and say, hey, do you want to work a deal? I can get you 50% off if you pay me right away or pay me over a couple of payments. This can lead to a couple of problems. Now, if you have a lot of debt and you're trying to work your way out of debt, then that's probably a good plan. But if you don't have too many and you can actually pay the full balance, pay the full balance due, because if you pay less than full balance due, they're going to report it as that. And it's going to be clear to your creditors and it's going to impact your credit score. So let's say it's $1,000 debt and they say, okay, well, if you pay me $500, I'll mark it as paid. Don't do it. Don't take the bait. Pay the $1,000 if you can do it, because the long-term impact to your score for the next 7 years is going to be significant. Tom, what about credit utilization?
Well, credit utilization is another factor. It's 30% by some measures of a person's credit score. And when you get to credit utilization, you're talking about how much credit do you have available and how are you using your credit. So, for example, if you had $100,000 in total credit line and you were using 50% of that, you'd have $50,000 in debt. So obviously that's a lot of debt in correlation to how much available credit that you have, versus if you had $10,000 of debt on $100,000 total credit line, you're only 10% of your credit utilization. So the lower your credit utilization, typically you see the higher credit scores. What are some tricks people can use to get a higher credit utilization?
Well, this is one of the major areas where consumers can actually do something to increase their credit score. So if, say, for example, in your example, you're at 50% of your credit utilization, that's going to seriously impact your score. So if you can pay that down, if you can get it down to, say, 10%, you're going to really improve your score. That's probably the biggest thing that you can do. So if you have some cash and you can lower your credit debt and lower the amount or the percentage that you owe, that's the best thing that you can do. Another trick is do not close out old accounts. Okay, so say you have an old account credit line and maybe it's $10,000, $15,000, but you haven't used it in a long time and you're thinking maybe I'll close it out. Don't do it, because if you leave it there and you have $15,000 available, but you're not using it, that's going to help your score. What about the next category?
Well, the next category is the length of your credit history. So this can be impactful if you have an old credit card that perhaps you're not using, but it's one of your longer term credit cards. You're going to want to go ahead and keep that credit card open, because if you close that, then that could affect how long your credit history is, and it could age out one of the older accounts. So that's not something you probably want to do. You also want to try to get your younger children with their credit established as soon as possible, so their credit history is longer. You can make them an authorized user on one of your credit cards and use various monitoring products within the account to make sure the child's handling the credit accurately, right, Hugo?
Yeah, I mean, hopefully they're going to pay it. But you can also put them on a joint account with you.
Well, the problem with that, Hugo, is the ultimately you're responsible for what your child's action is if you put them on your credit card. So you're going to want to go ahead and make sure that they're responsible enough and that they're going to handle it, because it could impact your credit score. If they're an authorized user and they ran up the debt, then you're ultimately responsible for the debt. So
yes,
I know I keep an eye on my children's credit cards.
All right, so the next category that's important is new credit, and that's where you're out applying for a new credit card, or maybe you're trying to open a Lowe's account because you're going to get a discount somewhere, or you're doing an auto loan. So most people think, oh, I really can't afford to have any credit inquiries on my credit report, and gee, if I go to a car dealership and I want to apply for a car loan, I want to avoid them pulling my credit. Multiple inquiries at the same time. For example, if you're looking for a car loan, you're also trying to open a credit card, that's going to negatively impact your credit score. But one of the things that most of these credit scoring models take into consideration is they know if you're looking for a car and they're shopping at the lender shopping it around to 6 or 7 different places, they know you're not looking to buy 6 or 7 cars. So it's not going to be that impactful. So you don't have to be that concerned about it. But obviously, if you are looking to buy a car and there are inquiries on your credit report, that's something that you want to keep an eye on.
Right. That's a good point, Hugo. And so basically what you want to avoid is a scenario where perhaps you apply for a credit card one day and a department store credit card the next day and a car loan the third day. This is going to look like you're running around trying to establish as much credit as possible. You're going to get penalized much more heavily for your inquiries under that scenario versus if you just go to buy one car and 3-4 banks are looking at your credit report the same day to offer you a better term of financing. Typically what we've seen is the credit scoring models take that into account. They know no one's buying 3 cars in one day, and they know that the inquiries are necessarily tied to one purchase. So that's the big key. I think oftentimes we get contacted from people and they're worried about inquiries having a dramatic effect and getting them deleted. And I personally, I don't feel like inquiries are necessarily going to make or break a credit score. How about you, Hugo?
No, it's only a couple of points. It's not going to be 10, 15, 20 points on your credit score if you have an inquiry out there. It's opening up the accounts that's going to be the issue. If you start opening up a bunch of new credit and they figure that you are your credit challenged and they want to keep an eye on you.
And I think that's why the score it's only 10% of the score. They're not really factoring that in. I mean, the biggies are you got to pay your bills on time and you don't want to have too much debt in relation to how much your credit is. That's why we started with that in this video.
Right. And the last category is the credit combination, sort of the mix of credit. Do you have auto loans? Do you have home loans? Do you have mortgage loans? Those sort of things. So, and that's not something that you're going to be able to do much to impact. I wouldn't recommend that somebody who's paid cash for their car go out and get an auto loan so that they have a better or a different mix. I think that's something that is not going to be one of the areas that you're going to be able to change. So, Tom, what kind of tips do we have for the average consumer on what they can do to try to improve their credit score and review their credit report to make sure that there's not something inaccurate on their credit report?
Well, the first tip for your credit score, I think, is to absolutely make sure you're paying all your bills on time. I mean, if you're not paying your bills on time, then obviously your credit score should be lower. Some people, again, like to automate those payments. I personally don't automate them, but I think if you're going to be forgetful and an automated process of getting your payments done will help remember you should probably do that. Other than that, be responsible with your debt and don't let any higher balanced account, meaning a higher car loan or your mortgage, ever get 30 days past due. Because the reason these types of debts are going to affect your credit score so much is those are the biggies. They know if you're starting to struggle financially, your mortgage will be the last thing you really want late. And when we see, or the credit score sees a mortgage late, they're going to know you're headed down a darker financial path.
Well, and there's also another problem with that. If you pay your mortgage late, if you're just 30 days late on your mortgage, the chances of you being able to refinance if the rates go down or to buy another house and get a new mortgage loan, that's not going to be something that's going to be available probably for the next 2 years. It really is going to have a long-term impact on your ability to obtain another mortgage. The other thing is that if you get behind on something, you've got to get it straightened out. You've got to get it paid in full. We've seen a number of clients that have gotten into the cycle where they're making a payment, but they're not posting it to the entire payment, and they keep going down the cycle of being 30 days late every month. And that can be a true problem. So if you get behind and you have the money, pay it off. Contact your creditor and make sure that you are good and you start back on paying the next cycle.
Well, another good tip, Hugo, I think, is don't let an account get charged off. Because if you typically look at how the credit reporting works, there's 30 days late, there's 60 days late, there's 90 days late. But then at some point, the creditor may have a financial obligation or a statutory obligation to write the debt off. Once the account is charged off, it will forever be reported as a charge off, even if you pay it. So it's very important to not let the account get charged off. And some of the creditors will, even if you contact them and you can pay a smaller amount, so you just stay 90 days late and you're not charged off, that could be beneficial to your credit score down the line as well, because you got to remember the credit reporting is mostly codes. So when they pull your credit report at the car dealer, for example, if it's an installment loan and you pay on time, it'll say I-1. If it's 30 days late, I-2, I-3, I-4 as you get later. So it's important to keep these codes, up to date so people can pay the loan. Or so you can show that if you got past due, you can get it current. Once it's charged off, you get to what's called a 9. And once it's 9, it never comes off a 9, even if you pay it off later. So that's an important tip, to not let something get charged off.
Yes, definitely not. That is considered a really catastrophic problem on a credit report. So obviously, see what you can do to solve that problem before it gets even 90 days past due. You want to stop it from ever getting to the area of collection or charge off. Definitely bad. And as we said earlier, if you do end up getting into this sort of financial, you've lost your job and you fall behind and you can't pay it, and you get to the point where now you're trying to clean up some of this mess. If you can pay these debts off in full, do it and avoid having to take the less than full balance due, because that is going to be a long-term impact as well. What are some of the other tips, Tom?
Well, if you're behind and you're in that scenario where you're negotiating, I would ask if they will do pay for delete. Now, pay for delete is probably somewhat controversial, I would think, because not everybody will do it.
No.
Some of the utility companies, they absolutely won't do pay for delete. But it's one of those things where I would ask. But again, you have to go ahead and document it and get it in writing that this is a disputed debt. I'm paying this to settle a disputed debt, and you're agreeing to take this to settle that dispute, and have some sort of writing to memorialize that they were going to take it off. Because a lot of times that's a debt collector can say one thing and then go ahead and take the money and leave it on your credit report anyway. So if you want to try to engage in that process of a pay for delete, get it in writing. And then ultimately that could be a good credit reporting case, right? You go where if you have a writing where it says, hey, they agreed to take $500 for this $3,000 debt, and I paid it, and you have your receipt where you paid them, and you have a letter where they agreed to take the $500, and they just still leave the $3,000 on your credit report, then that potentially could be a case that is a credit reporting case with an inaccuracy, right?
Yeah, definitely. I mean, normally they'll show a credit for the $500. So instead of $3,000, now they're showing you as $2,500. But a good point is that if you do enter into some kind of negotiated agreement where you're going to resolve an old or outstanding debt, make sure you check your credit report. Check it. So go to annualcreditreport.com. You can get a free credit report every year from each of the 3 bureaus, and check and see how they're reporting it. I mean, give them 30, maybe 60 days after you've settled it and you've paid it, but make sure it's reporting as a zero balance. It's been paid off, because a lot of times you can negotiate a deal like that and they don't accurately report it, and you're still going to have some very major credit reporting problems. So make sure you go back and check it and follow up on that. And if you can't get it fixed, well, then you probably need a good credit reporting lawyer to help you out with that. What other points do we have for them, Tom?
Well, I think we talked about not closing out old accounts, and some people enjoy spreading their debt over multiple credit cards. So what's your opinion on that, Hugo?
I think that's a good plan. I don't think, suppose you have a credit card that has a $10,000 limit on it, and it's your favorite airline card, and you're trying to get the airline miles, and you keep running it up every month. You're better off having a couple thousand on a different card rather than having that one maxed out. So if that one has a credit limit of $10,000, you don't want to keep it up at the $10,000. You want to try to keep them spread out. So if you can keep them all a little bit lower, that's going to help improve your scores.
Okay. I think these are good tips, Hugo, that we've provided everyone. Is there anything you want to add?
No, if you go back and you look at your credit report, okay, and you have something that's inaccurate on your credit report, you feel like you paid them on time, you have proof that you did it, you're definitely going to want to dispute that with the credit bureaus, and you want to get that off. And if you can't, or you want help, then you should definitely contact a credit reporting lawyer, somebody like us. One thing that consumers probably don't know is that most of the lawyers like us will take these cases on a contingency fee or percentage fee basis. So you're not going to have to pay thousands of dollars to get a lawyer to step in and try to help you clean this mess up. These are kinds of things that we can do, and we can do without a big bill to you. And ultimately, if they don't take it off and it's inaccurate, then we'll end up suing somebody.
Absolutely. If you enjoyed this video, hit the like button and subscribe to our channel. Please view other videos, including inaccurate information and how to dispute it in inaccurate automobile leases. Until next time, take care of your credit and dispute inaccuracies.
Thanks for watching, and we'll see you next time.